myself, I have great pleasure in welcoming you to this, the 14th Nani Palkhivala Memorial Lecture. The lecture is organized in association with the Bombay Chartered Accountants Society, the Forum of Free Enterprise, and the Indian Banks Association. And I would like to extend a warm welcome to all the members of these associations who are present here, and particularly to Mr. Nani Palkhivala, President of the Bombay Chartered Accountants Society, to my co-trustee, Mr. Ranina, who is the chairman of the Forum of Free Enterprise, sorry, and to Mr. Rajiv Rishi, chairman of the Indian Banks Association, who hasn't come here yet. For the last 7 years, the Nani Palkhivala Memorial Lectures have been sponsored by ACC, and today's lecture is also sponsored by ACC. We are grateful to them for their continued support and generosity. ACC had a special place in Nani's heart, except for a brief interlude when he was India's ambassador to the US. Nani was chairman of ACC for over 27 years, and he used the annual chairman's statement as a vehicle for expressing his opinion on the state of the economy and the performance of the government. We are honored that Mr. Neeraj Akuri, the managing director of ACC, has graced this occasion with his presence. And I would request Shirin Barucha, my co-trustee and secretary of the trust, to present flowers to Mr. Akuri as a token of our respect and gratitude. As many of you are aware, the Nani Palkhivala Memorial Trust was established to perpetuate his memory and carry forward the causes to which he devoted his life. In furtherance of these objectives, a wing of the Supreme Court Bar Association Library is named after him and contains his portrait. Nani Palkhivala gold medals are awarded annually to the top LLM students in 14 major colleges. We have present here with us today Ms. Neha Bandari, who secured the gold medal in Mumbai University in 2015-16. And I would request Shirin to present her with flowers and a small memento. To continue, we have published 3 books: a biography of the late Nani Palkhivala by the late Mr. K.M.V. Kamath, a book titled Nani Palkhivala, the Courtroom Genius, authored by Mr. Soli Sorabji, our co-trustee, and Mr. Arvind Datta, senior counsel, and The Wit and Wisdom of Nani Palkhivala, edited by Mr. Jignesh Shah. We've also produced a film, Nani the Crusader, directed by Mr. Cyrus Barucha, and we hold annual elocution competitions for law students, where last year 9 colleges participated and sent their representatives. An important initiative taken last year was to initiate Nani Palkhivala Memorial Lectures. These are delivered by eminent persons in the leading IIMs and the IITs in the country. These institutions house the brightest minds amongst the youth in the country. And the object of these lectures is to initiate amongst the youth an informed debate on matters of national interest. To date, 10 such lectures have been delivered, and we have planned for several lectures in this year also. The Trust has also instituted a Nani Palkhivala Award for Civil Liberties and Human Rights, which is given to individuals and institutions selected by an independent jury. So far, awards have been given to 9 individuals and 4 institutions. The most important event, however, remains the annual Nani Palkhivala Memorial Lecture. In the preceding 13 years, we've had as speakers 2 justices of the Supreme Court, 3 governors of the Reserve Bank, 3 cabinet ministers, 3 eminent jurists, and 2 business leaders. And for this year's memorial lecture, we have for the first time invited a commercial banker. And we are honored that Mrs. Arundhati Bhattacharya, the chairperson of the State Bank of India, has accepted our invitation to deliver the 14th Nani Palkhivala Memorial Lecture. Mrs. Bhattacharya has selected as her subject, how can bank mergers lead to shareholder value creation? A subject which is both topical and important. When in 1991, the Narsivan Committee, of which I was a member, recommended the merger of banks to create a few large banks, the commercial banking scenario was totally different. There were no large private banks or no large non-banking finance companies, and the main competition to public sector banks was provided by the branches of the foreign banks. It was felt necessary at that time to create large Indian banks in the context of the emerging globalization of the economy and to meet the competition both in India and abroad. But since then, the landscape of commercial banking has changed significantly. Financial inclusion has become a major objective. Payment banks and small finance banks have been licensed. 2 new banks have been formed, and the licensing of new banks is now on tap. And private sector banks have become a major competitor to public sector banks. In this changing environment, new competition to public sector banks has emerged. But in my view, the battle will be fought not on the grounds of interest, but on the basis of quality of service. In this continuing debate, which has taken place between the government and the RBI on interest rate policy, there is one aspect which has not been adequately articulated. While the repo rate is an important signaling instrument, its actual impact on interest rate costs and therefore on lending rates may be somewhat limited. The bulk of interest costs in a bank arise out of deposits, and interest costs can be reduced only if deposit rates are reduced. In most advanced countries, there is an identity between the depositor and the borrower. Depositors are in most cases also borrowers in the form of housing loans and credit card holders. Therefore, when interest rates fall, what they lose as depositors, they gain as borrowers. But in India, these classes are totally distinct. The depositors are pensioners and small income holders who cannot risk the alternate forms of investment, and there are therefore large social costs involved when deposit rates are reduced. It is in this context, I believe, that mergers of banks can play an important role, if they can reduce operating costs and thereby reduce the pressure on interest costs. Mergers of banks will provide an opportunity to make the massive investments which are needed in technology, to upgrade staff and rationalize operations, without which quality of service and operating costs cannot be improved and operating costs cannot be reduced. This will inevitably result in staff redundance and the closing of duplicate offices, and the gains of mergers will not be realized unless there is political will to accept these sacrifices. The recent merger of the 5 associate banks with SBI is therefore an opportunity to demonstrate the path which future mergers of public sector banks should take. There are a number of issues which the present merger must have raised, and there is no one more qualified to explain this than Mrs. Bhattacharya. It is not easy to be a chairman of a public sector bank. It is even more difficult when the public sector bank is by far the largest bank in India. But Mrs. Bhattacharya has brought to bear on her office her 39 years' experience in the financial sector, both in India and abroad, and the fact that she has done so successfully is evidenced by the confidence she enjoys in the government and the respect she has earned from her compatriots, both within the SBI group and with her peers in competing banks. She has also won recognition from the leading global financial publications. Forbes magazine in 2016 has ranked her 25th in their list of most powerful women in the world and 5th in the most powerful women in finance. Fortune magazine has featured her in the top 50 globally most powerful women in business and among the top 5 in the Asia-Pacific region. And it has also ranked her 26 in Fortune's World 50 Greatest Leaders list, the only Indian corporate leader to be featured in the list. We are indeed privileged that Mrs. Bhattacharya has accepted our invitation to deliver the 14th Nani Palkhivala Memorial Lecture on the subject, How can bank mergers lead to stakeholder value creation? Before I invite Mrs. Bhattacharya to deliver the lecture, I would request Shirin to present her flowers and a small memento as a token of our respect and appreciation. Mrs. Bhattacharya, would you like to speak?
Good evening, everybody. Respected trustees of the Nani Palkhivala Memorial Trust, distinguished guests invited for today's evening, other notable personalities of Mumbai city, and fellow Mumbaikars. It is my honor and pleasure to be amongst you all this evening. First of all, sir, my sincere thanks to the Nani Palkhivala Memorial Trust, particularly you, Sri Y.H. Malegam, the widely respected chairman of the trust, for extending me this signal honor of delivering the Palkhivala Memorial Lecture for this year. I am conscious that many eminent thought leaders have delivered this memorial lecture in the past, and I attach a lot of value to adding my name to that very select list. The late Mr. Nani Palkhivala is remembered as a personality of unmatched charisma, a charisma derived by the sheer aura of his vast knowledge and expertise in the field of law. He commanded respect equally among his fellow colleagues and his critics. A man of principles who rose from very humble origins, by capitalizing on every big and small opportunity that came to him on the back of sheer hard work, obsessional time management, and professionalism. Who would have believed that a studious child who loved reading but had a stammer in his childhood would one day mesmerize the judges with his unrivaled command over the language? The presiding judges would take a week to come out of the spell Palkhivala would cast with his power of words, was said by Justice Slate H.R. Khanna. I will only say that the spell cast by Mr. Nani Palkhivala continues to this day. As a banker, I will remember Mr. Palkhivala for one other reason. On July 19, 1969, when the President of India promulgated the ordinance nationalizing 14 banks, it was Mr. Palkhivala who moved a petition before the Supreme Court on behalf of R.C. Cooper. R.C. Cooper versus Union of India, popularly known as the bank nationalization case, will forever be remembered in the history of Indian jurisprudence as a turning point in the interpretation of fundamental rights and scope of judicial review. What interests me most is the arguments that Mr. Palkhivala advanced during his submissions. He compared banking structures in countries like Canada, Japan, France, the US, and the UK, and went on to argue that even the acquisition of all the private banks in India would not suffice to meet the development needs of the country. Was Mr. Palkhivala right? To an extent, yes, he was. India did discard socialism in 1992, but it is only after the success of the recently conducted Jan Dhan Yojana beginning in 2016 that India can say banking has at last reached the common man. I reflected quite a bit on an appropriate topic for a lecture to honor the memory of such an eminent public intellectual. I was also cognizant of the fact that this will possibly be my last public lecture as the chairman of State Bank of India. Given the Palkhivala context that I just recollected, my thoughts started centering around the topic bank mergers and shareholder value creation. In 2 years' time, we will be observing the 50th year of the bank nationalization, and this year is the 25th year of the first generation reforms initiated in 1992 in respect of banks. In the spirit of Mr. Palkhivala's commitment to liberal economic thinking, which became the touchstone of our policy making in 1990s, I feel this topic must be addressed in its proper perspective. Mergers and acquisitions among financial institutions are a worldwide phenomenon, and the rapid pace with which industry underwent consolidation has been compelling. The United States leads, as it does in so many other ways, with the largest number of M&As in the world. Bank mergers drove the long-term downward trend in the number of banks in the US since 1985. Even in the crisis periods of 1980s, 1990s, and even in 2007 to 2009, the number of mergers in the US exceeded the number of failures every year. About 90% of the 1,500 mergers since 2007 in the US involved a bank with less than $1 billion in assets. In general, acquired banks were often smaller, less profitable, less efficient, and in weaker condition than their non-acquired peers. In Europe, the merger and consolidation in banks were significant during the decades of 90s and 2001, here due to the introduction of the euro. Over the 2 decades, the European banking sector witnessed significant structural changes that resulted in its consolidation and increased cross-holdings. As a result, the number of credit institutions in the EU dropped from approximately 12,000 at the end of 1990 to just over 7,000 at the end of 2004, with the majority of M&As being domestic deals. The peak in M&A activity in Europe was recorded in 1999. It is also worth noting that during the 1990s, the majority, that's about 80%, of bank M&A deals in Europe took place in the 4 member states of Germany, Italy, France, and Austria, and again involved small and very small banks, and these were keen to achieve adequate size to allow survival. The increased number of deals between larger banks evolved from the need of strategic repositioning rather than that of survival. All through these years, the pace of merger has never been uniform across various advanced countries, and local policy objectives have normally guided the eventual outcome. For instance, in Canada, domestic banks traditionally controlled a large share of the banking sector, owing to a dominance of a few banks in the industry. Consolidation in Canada is regulated through a guideline established in 2000 to ensure that it does not lead to unacceptable levels of concentration, drastic reduction in competition, and reduced policy flexibility. Thus, in Canada, not much consolidation has taken place since the 1990s. Nevertheless, the 2007 financial crisis has dramatically slowed down the consolidation rate in the banking world across the world, and new proposals now call for much more rigorous research. Mergers among banks between the years 2000 and 2010 were usually large and characterized by high transaction values. Mergers among the US bank had a combined transaction value of more than $375 US, and the total value of intra-European transactions exceeded 330 billion. As you are well aware, during the financial crisis, many of the largest bank consolidations were actually driven by government mandate, be it the consolidation between the Bank of America or Merrill Lynch, or the takeover of Wachovia by Wells Fargo, or that of Washington Mutual by JP Morgan. All of these were actually engineered by the government. In fact, sir, I remember the head of our treasury at that point of time, one Mr. Barua, he told me that his son, who was in Citi, had always told him that being in a public sector bank was not where anybody should be. On the night when the government of the US funded Citibank, he called him at 12 in the night and said, "Son, welcome to the public sector." So there are times when these things have to be done, and in the US, during that period at least, most of these bank consolidation, though large in number, were actually driven by the need for survival rather than for strategic repositioning. Asia also witnessed a bank M&A wave during the same period, but due to a different set of reasons. In Japan, the consolidation in banking occurred after the bubble burst in 1989. In 1998, the Japanese government responded to the crisis by launching a comprehensive bank bailout plan, followed by a consolidation leading to the formation of some of the largest bank behemoths in Asia, like the Bank of Tokyo Mitsubishi. Following the East Asian crisis, banking in many Southeast Asian countries also came under severe stress. This led to a variety of responses depending upon the local conditions in consonance with IMF prescriptions. For instance, in Thailand, foreign banks took control of 2 domestic banks. The foreign ownership was also most noticeable in South Korea, where foreign entities took 51% stake in Korea First Bank. By 2001, 5 out of 12 large Korean banks were foreign-owned. Indonesia, which was one of the worst affected by the crisis, however, followed a very different path for bank consolidation. In consultation with the IMF, the Indonesian government formed the Indonesian Banking Restructuring Agency as a confidence-building measure. Immediately after its establishment, the IBRA introduced restructuring measures such as successive takeovers of ill-performing banks and gaining full control over banks by changing its management. On the other hand, it supplied liquidity to prospective banks and promoted business restructuring in the healthy banks. The plan, although not perfect, initially succeeded eventually in restoring the confidence in the banking system. During the period 1997 to 2000, 19 banks were consolidated and 4 merged banks were formed. In 2004, the IBRA was disbanded. Subsequently, with the dissolution of the IBRA in February 2004, the Indonesian banking sector came back to normal. At present, Indonesia has one of the healthiest banking systems in Asia, with the highest equity to asset ratios amongst Asian banks and a manageable bad loan ratio of less than 4%. While going through these various experiences of various countries, sir, I found that the Indonesian experience probably most closely resembles what we are going through in India. And therefore, there are lessons that we can learn from their experience that they went through. Now, consolidations of banks through M&As in the Indian context is also not a new phenomenon. In fact, since the beginning of modern banking in India, the first significant merger was in respect of the pre-independence era of the 3 presidency banks founded in the 19th century, which were brought together in 1935 to form the Imperial Bank of India, that is our predecessor. In 1959, SBI acquired the state-owned banks of 8 former princely states. In order to strengthen the banking system, the Travancore-Cochin Banking Inquiry Commission recommended, this was set up in 1956, it recommended for closure amalgamation of weak banks. Consequently, through closure amalgamations that followed, the number of reporting commercial banks declined from 561 in 1951 to only 89 in June 1969. During 61 to 69, 36 weak banks, both in the public and the private sector, were merged with other banks. There have been several bank amalgamation in India in the post-reform period as well. In all, there have been 44 M&As since the nationalization of 14 major banks in 1969. Of these mergers, 26 involved mergers of private sector with public sector banks, while in 13 cases, mergers were between private sector banks, and in 5, they were between public sector banks. Out of the 44, 21 M&As took place during the post-reform period, with as many as 22 mergers and amalgamations taking place during 1999 and after. Prior to 1999, the amalgamation of banks were primarily triggered by the weak financials of the bank being merged, whereas in the post-99 period, there have also been mergers between healthy banks driven by business and commercial considerations. One such was the merger of the Kotak Mahindra Bank that we witnessed just a year or two ago. Merger and amalgamations involved relatively small banks. The largest number of mergers took place with ICICI Bank, Bank of Baroda, and Oriental Bank of Commerce. ICICI Bank replaced many entities to become the second largest bank in the Indian banking sector after SBI. But with the present merger of the 5 associate banks and the Bharatiya Mahila Bank, SBI will continue to lead the pack for a long time to come. With this mega merger, for which, sir, we have sought the Guinness Book of World Records mentioned therein, the number of PSU banks is down to 21, and the vision of Narasimham Committee 1991 that SBI should progressively merge all the 7 subsidiaries with itself stands achieved, albeit 26 years after it was first envisaged. Consolidation in Indian banking was also visible beyond the commercial banking space. Following the recommendations of the Vyas Committee 2005, the National Bank for Agriculture and Rural Development amalgamated 196 regional rural banks established under the multi-agency approach to rural lending in the country during a 15-year period till 1990 into 64 banks by 2013. This amalgamation has as yet met with only partial success, as the RRBs are still far from achieving the objectives for which they were created in 1975. If mergers in banking have been so common, the critical question that arises is how should their success be measured? What are the deciding factors that make a merger proposition successful and value-creating? Normally, it is considered that merger and acquisition activity result in overall benefits to shareholders when the consolidated post-merger firm is more valuable than the simple sum of the two pre-merger firms. The primary cause of this gain in value is supposed to be the performance improvement following the merger. The notion of performance gains has focused on improvements in any one of the following areas, namely efficiency improvements, increased market power, or heightened diversification. Thus, in order to measure the success of M&A amongst banks, the three most prominent methodologies in empirical research are event studies, efficiency studies, and performance studies. The event study approach directly measures the impact a merger or acquisition has on shareholder wealth. Therefore, a successful M&A transaction is one in which shareholders receive significant positive abnormal returns. Efficiency studies, on the other hand, judge an M&A transaction to be successful if the post-merger efficiency of the combined institution moves closer to the efficient frontier, which is usually considered to be the most efficient institution in the sample. Finally, performance studies consider improved accounting ratios to be a sign of a successful M&A transaction. Here, I must say, the only issue that we have in India is that all of these, at least the media and the analysts, feel should be achieved in 90 days, which is really not possible. We need to give any merger time for them to display what I have just talked about. All the methodologies are correct from their particular point of view, but none is complete because each one of them adopts a different definition of success. The methodologies largely focus on the owners, that is the shareholders, of the acquiring institution to evaluate the success of a merger. Yet, it is not clear whether shareholder wealth creation, increased efficiency, or better accounting ratios are actually the best measure to judge the success of an M&A. Sir, as you rightly said, should successful mergers actually translate into lower costs for consumers and more stable financial markets? And that should be the true measure of a success of a merger. This particular question as yet remains largely uninvestigated. If one surveys such studies for the US and the European markets, their conclusions have been rather mixed. Some studies show gains while others don't, and their results are sensitive to the time period chosen. But what is evident is that as banking markets matured over time in these regions, it ought to become more difficult for the acquiring institution to outperform its peers. The takeover market is also very competitive, and a bidding bank may be forced to pay a high premium for a target. This, in turn, will lead to a more critical judgment of the value proposition of transactions by capital markets, and will also likely be a drag on the financial performance of the newly combined institution. After the 2008 Western financial crisis, international Western banks are downsizing or withdrawing from the Asia-Pacific region. As a result, the ensuing vacuum will be filled by domestic and regional banks with a wave of new competitors hot on their heels. And this is something that we are seeing in India already. The region is already witnessing new types of competitors, from the rapidly developing fintech sector, offering new banking, payment, and financing options. Mega banks rise across the APR will be hastened by the market integration promised also by the upcoming ASEAN Economic Community, which will enable banks to operate more easily across borders. In many countries, therefore, smaller players will need to consolidate if they are to compete against banks from other markets. Governments are introducing a carrot and stick regulation to encourage the emergence of national champions that can compete more effectively domestically and across borders. Thus, the ultimate deciding factors underlying the success of mergers involves a complex nexus between the characteristics of the partners and transaction-specific factors such as geographic focus or product focus, and environmental features such as deregulation, government policy, and economic conditions. Amongst the most important drivers behind a successful merger in the banking industry are large efficiency and performance differentials between the acquirer and the target, prior acquisition experience, financing M&As with cash rather than stock, and high regulatory efficiency and quality. There is no clear conclusion on whether geographic or product focus or geographic or product diversification is more beneficial for M&As amongst banks. Furthermore, in the context of banking consolidation process, the report of Committee on Fuller Capital Account Convertibility observed that some of the smaller banks which specialize in certain areas of business or regions may have a comparative advantage over larger banks by virtue of their core competence. As such, emphasis merely for consolidation to mean larger banks merely by these sort of mergers may not actually lead to strengthening of the banking system. In other words, there is no immutable relationship between size and operational efficiency. Now I will try to address the question whether mergers create value and what is the relevance of bank mergers in India going forward. This is not an easy question to answer because the available empirical literature is rather inconclusive on the benefits, and as far as Asia is concerned, such literature itself is rather sparse. Bank merger and hence consolidation will occur in Asia, but the drivers will be different from Europe. In the present geopolitical context, health of the banking sector is invariably the most vital indicator of financial stability as also currency stability. This is partly dictated by the past history of banking crisis in this region. If the banking sector is government-owned, its strength is an expression of national power itself. As John Kenneth Galbraith argued in his book, The Anatomy of Power, economics divorced from consideration of the exercise of power is without meaning and certainly without relevance. The example of large government-owned Chinese banks who have yielded enormous financial power across various countries in Asia, Africa, and Latin America, thus shaping China's foreign policy, becomes obvious from this angle. It is therefore my contention that geopolitics will shape the course of banking in APR. But will government ownership provide the banks with resilience and flexibility? A state has the capacity to absorb short-term losses in its quest for long-term strategic gains. If this principle is exercised through state-dominated banks, how far can we take this? India, the second largest economy in Asia and an aspirant for superpower status, cannot actually escape this reality. Thus, government has repeated many a times that consolidation in public sector banks is imperative so that Indian banks are globally competitive. It is also essential that domestic banking undergoes some consolidation before we finalize our free trade agreements with ASEAN so that the cost of fund advantage is preserved. The reasoning goes equally for other possible FTAs and multilateral agreements that India may sign in the future. However, pure strategic gains can often mask commercial considerations. The success of bank mergers, viewed from strategic angle, is limited particularly in the Indian context, where there are many stakeholders. Besides the government as the largest stakeholder, QIPs, customers, employees, and the Reserve Bank itself are all important stakeholders in this project. The primary objective of the Reserve Bank and the government in the process of consolidation is to ensure that mergers are not detrimental to the public interest of the concerned banks, depositors, and shareholders, and also that they do not impinge on financial stability. The Reserve Bank ensures that after a merger, acquisition, construction, or takeover, the bank or banking group has adequate financial strength and the management has sufficient expertise and integrity. From a shareholder's point of view, that includes both government and institutional investors, mergers must result in shareholder value creation. From a government point of view, besides an increased stream of dividends, which forms a part of its non-tax revenues, mergers must also deliver by reducing the dependence of the merged entity on the government for future capital infusion. Mergers in PSU banks must increase the role of internal and market resources and thus reduce government dependence. The efficiency of public resources deployed in PSU banks must increase. From an institutional investor point of view, the available market float of bank shares must appreciate after a merger. These considerations have at least guided the merger decision of SBI and the associate banks. Since capital is the limiting factor as far as banks' business is concerned, after the merger, SBI has moved to an ROE-based budgeting along with risk-based budgeting in managing its portfolio. The duplication of resources, such as in its administrative setup, its branches and ATMs, multiple treasury units, as well as duplication of investment in risk and compliance function, will now be reduced. As a merged entity, SBI can now optimize on spatial scale the deployment of its resources and consolidated manpower. Coupled with technology integration, these efficiencies will show up in the future financial and overall business growth. Sir, you posed a question regarding the reduction of human resources. And this is actually an area where the government has very clear ideas. They are not at all keen to see a reduction of the human resources employed by the bank. But luckily, India is one of those few countries where banking has still not reached its peak. There is a lot of depth in the entire Indian subcontinent where banking can be extended in very many ways to very many people. And therefore, we at the present moment do not see any reason for undertaking a cut in resources. However, what will happen will be the reallocation of human resources in areas that will be more value accretive rather than in areas which are only in the nature of handling transactions. The merger of any two entities throws up this complex issue of human resource management, employee integration, and above all, the psychological and perception management. This is true for any type of merger, but in case of banks, which are manpower intensive, loss of morale after mergers is of a serious consequence. To add to this, there are the costs of integration of employee front. As far as SBI is concerned, HR integration cost was only in respect of VRS. The additional superannuation fund provision for employees of associate banks would be just about rupees 25 crore a month, which is insignificant given the size of the bank. However, this may not be a case in respect of all future merger of PSU banks. Here, I would like to say that this is one particular area of merger which received enormous importance in the bank. From day one, we have started a communication exercise to advise the entities getting merged that each and every one of the people would be cared for and their interests would be looked after. Technology has been a huge enabler in this. We had created several blog sites where we could directly put our thoughts, and any and everybody of the merged unit's employees could also write to us. Grievance portals were put up, FAQ sites were opened, and there was a time when our people were answering more than 200 questions on a daily basis, put up by the employees of the entities getting merged. In fact, very recently, one of the newspapers pointed out that the entire market was surprised that there were no employee disturbances or employee grievances that had come to the fore in any great extent. In fact, out of all the promotions and the postings that we have done, we have received only 25 letters of grievance. So to that extent, what was done was to reach out to people, to have people who acted as mentors for the incoming entities, and to ensure that whatever were their requirements, that we took note of them, and within the constraints of the organization, tried to take care of it to the extent possible. Now, the impact of merger on the customers of the entity getting merged in all its dimensions is, again, not a well-researched area. In case of bank mergers, it is expected that the merged entity will pass on to the customers the efficiency gains. It is also expected that economies of scale will favorably affect the pricing of its products. In case of SBI merger with associate banks, these factors are indeed favorably placed, though it will take a little time to play out. After the merger, the costs of funds for the merged entity have only marginally increased by 10 basis points. This too is expected to reduce as the costlier resources of the merged entities get repriced over time. This is because the merged entities being smaller in size, they would take customer deposits at a higher rate than would be available to the larger entities. It is expected that there will be no adverse impact on the pricing of credit portfolio as the pooling of funds under the common treasury and the rationalization of branches all over the country will bring down the operational cost, and this will compensate for the 10 basis points rise in cost of funds. From the technology point of view, SBI was much ahead in this area as compared to its erstwhile associate banks. Hence, the erstwhile associate banks' 70+ million customers will have the advantage of access to better technologies after the merger. However, I feel that one larger question still remains unanswered. What will be the impact of the bank consolidation on the wider economy, as 40% of the domestic savings are parked in bank deposits? Sir, you raised the same question, that this is one of the peculiarities of the Indian banking system. We have actually thought about this time and again. If you compare a bank in a developed economy, normally, not more than 70% of their resources are deposits. In fact, at the time of the Lehman crisis, it was only 50% that came from deposits. The rest came from the markets. And in fact, because it came from the markets at the time of the Lehman crisis, because the markets froze and people refused to lend, that the banks all got into such a crisis. However, what it does do, if you have lesser deposits and more market borrowings, is that it makes the ability to transmit the monetary policy signals into the market that much easier. In respect of the banks in India, 97% of our deposits come from depositors. Only 3% are market borrowings. Now, should the Reserve Bank of India cut rates or raise rates, it impacts only that 3%. And obviously, therefore, it is very difficult for us to pass this on to our customers when the actual impact on our cost of funds is so minimal. So therefore, there is a question that if this is the way our economy is, how will the bank mergers help or hinder whatever is happening in the country? Consolidation will lead to greater concentration also of the payment and settlement flows among fewer parties within the financial sector. Now, is this also going to be a hindrance or is this going to be beneficial? But given the cybersecurity risks that we currently run, probably this could also be beneficial. However, operational risk could increase with the size of operations as the distance between management and the operational personnel is greater in large companies and the administrative systems are more complex. There is also a view that the exercise of market power by the banks resulting from consolidation could also alter the monetary transmission operating through bank lending to borrowers without direct access to financial markets. In a nutshell, bank merger may increase the systemic risks, and therefore mergers guided only by pure capital adequacy considerations are ill-advised. Another aspect of bank mergers in the Indian context is their role in infrastructure lending. After the phasing out of the development financial institutions, which catered to long-term lending and the persistent lack of liquidity and lack of depth in corporate bond markets, the responsibility of infrastructure lending should not be completely devolved onto the merged banks. Because remember, with the merged banks, their ability to take bigger bite size of the loans that are being syndicated will actually increase. Even if the merged entities are better placed in terms of fund mobilization and cost of funds, the exposure of the banking system to the infrastructure sector and associated asset liability mismatches would not be easy to tackle. In fact, they may become more complex and difficult to handle in a post-merger scenario. Let me now conclude. Over this course of this lecture, I have looked at various aspects of bank mergers. Nevertheless, the process of consolidation through mergers and amalgamations gained momentum in India during the latter part of the 1990s, contemporaneously with the global wave of M&As in banking, which led to a decline in the number of banks. Mergers and amalgamations were largely market-driven, with the regulator merely acting as a facilitator. With 36 mergers, there is really no sign that there was loss of competition in Indian banking. In fact, banking in India is still more competitive than most of the advanced markets. The present merger of SBI with its associate banks may therefore be a template for future consideration or consolidation of PSU banks. The logic for consolidation in India was based on two explicit or implicit assumptions. First, there are too many banks in India. Second, if the banking sector has to be assessed in the international context, size is the most important factor. After the 2008 crisis, we have to live with the reality that too few banks can also be part of the problem, and that size of the bank need not always guarantee its survival. Further, size can be both a weakness and strength in the context of the huge changes in technology that we are witnessing on a daily basis. A small, nimble bank may be able to evolve rapidly to keep up with the change, but may lack the financial strength to continuously incur the required level of spends on technology. A large bank, on the other hand, may have the financial heft, but may lack the ability to internalize change at the speed required. It is therefore those institutions that can do both that are likely to come out on top, and as such, M&A between banks needs to necessarily answer the question as to the likelihood of the merged entity being capable of being both nimble and yet large. Lastly, the Indian banking sector is at a critical juncture and is faced with several challenges and issues. These relate to the nature and extent of further consolidation, the changed environment for public sector banks, and the capital constraints faced by them due to government ownership, as well as the further opening up of the banking sector to competition from banks and non-bank entities. The reordering of international trade relations will heighten the need for bank consolidation to preserve our competitiveness. It is important that in the clamor for consolidation, we do not ignore the role of small and niche banks. They too have important roles to play in last-mile connectivity and grassroots innovation. Within this limited context, there is indeed scope for consolidation, partly dictated by domestic need and partly by national interest. Before I conclude, I would take this opportunity to state that it has been an enormous privilege for me to serve as the chairman of State Bank of India. There were taxing times, testing times, and anxious times. But as the joke goes, in the community of lawyers, the best case law emerges from the trial of the most seasoned crook. In the same way, I had the chance to oversee a unique merger in the history of world banking, and it is my belief that the successive generation of leaders at SBI, as well as in the industry, will identify and reap its benefits. Thank you all.
Ladies and gentlemen, it's a privilege for me to propose a vote of thanks. I'm totally at a loss of words to express my appreciation of the fantastic speech which has been delivered by our honorable guest today. If Mr. Palkhivala was a doyen among lawyers, Mrs. Bhattacharya is a doyen among bankers. And I think this country is fortunate to have had at the helm of affairs of the largest bank in India, the State Bank, a woman of her exceptional abilities. I was just told before this lecture that this is the only case where the chairman of a bank's tenure was extended by 1 full year. And this is a tribute to her brilliance as a banker. And I think we are eternally grateful to you, madam, for what you have done for the State Bank of India and for the banking sector. At the same time, she has given us words of caution. I remember the words of a great author who said, "Too big to fail." He wrote a book, "Too Big to Fail." Lehman Brothers failed, however big they were. So even if you're big and strong, you can fail if you don't have the right inputs at the right time. And therefore, I think Mrs. Bhattacharya has given us a good message that though there's a room for large banks, there's also a room for small niche banks. And that is a lesson which we will take away from this lecture. I think management students who are sitting here today, you could not have had a better lecture on mergers and acquisitions than what you heard this evening. And we would be delighted to bring out this lecture in a book, publish this lecture in a book, and have it widely circulated among members of the public. So thank you once again, Mrs. Bhattacharya. Please give her a round of ovation. I would also like to thank Mr. Akuri of ACC Limited for having sponsored this lecture and the lectures in the past. We will be having one more memorial lecture in December, and that will also be sponsored by ACC Limited. So thank you very much, sir. I would also like to thank the other sponsors, the Bombay Chartered Accountants Association, the Indian Banks Association, and of course the Forum of Free Enterprise, which is part of the group of trusts which conduct these educational programs. Just one point, the Forum of Free Enterprise has been in this field since 1956. Recently, we set up 3 more trusts, the Nani Palkhivala Memorial Trust, A.D. Shroff Memorial Trust, and the M.R. Pai Memorial Trust. And we have a very dedicated band of employees who are responsible for organizing these lectures. One of them, Mr. S. Divakara, has been with the Forum of Free Enterprise and a sister trust for the past many years. And having reached the age of 75, he will be resigning at the end of this month. He will retire, and he wants to relocate to Bangalore. So I would like to pay my tribute to Mr. Divakara for having worked with such dedication. Ladies and gentlemen, thank you very much for being here this evening. It's been a pleasure to have you here. We hope to see you again in our future memorial lectures. May I now request you to rise for the national anthem.